Something unusual is happening in the silver market right now, and most people are completely missing it. Imagine this. The price of silver suddenly drops hard, scaring investors, shaking confidence, and making it look like a weak asset. Normally, this kind of price action pushes people away. But instead of running, some of the biggest players in the world are doing the exact opposite. They are buying more than ever before. This is where things start to get interesting. Right after silver prices got heavily beaten down, China recorded the largest single monthly import of silver in history. Not just a strong month, the biggest ever. And when you combine the numbers from January and February, the scale becomes even more extreme. We are talking about record-breaking demand at the exact moment when the price is telling everyone to stay away. Now think about this carefully. If silver was truly weak, why would massive buyers rush in so aggressively? This is the first major signal that something deeper is happening beneath the surface. At the same time, there are signs that physical silver is quietly moving out of Western systems. Large quantities are being taken out of storage, loaded onto trucks, and transported elsewhere. This is not small retail buying. This is large-scale movement of real, physical metal, measured in millions of ounces. And here's where it becomes even more important. There is a mechanism in global markets called exchange for physical. This allows large players to buy contracts in Western markets and then convert those contracts into actual physical metal in places like Hong Kong. From there, the silver can be transported directly into Asian markets, including major exchanges in China. So what we are seeing is not just buying, it's a transfer of metal from west to east. Now step back and look at the bigger picture. On one side, the price is going down, creating fear and doubt. On the other side, massive amounts of physical silver are being accumulated and moved across the world. These two things should not normally happen together, but right now, they are. This tells us one very important thing. Price is not telling the full story. In fact, price may actually be misleading the majority of investors. And this is where smart money operates differently. While the average investor reacts to price movements emotionally, large institutions and sovereign-level players focus on long-term positioning. They are not chasing short-term price trends. They are accumulating assets quietly, especially when prices are weak. This behavior has been repeating for months now, and it's not slowing down. We are also seeing increasing activity in physical deliveries, meaning more contracts are actually being converted into real metal instead of just being traded on paper. Historically, most contracts in these markets were never meant for delivery. They were used for hedging or speculation. But now, that pattern is changing. More participants are choosing to take actual delivery of gold and silver. And when that happens at scale, it puts pressure on the system, because there is always far more paper than physical metal available. This creates a critical imbalance, and when you combine all these signals, record imports, large-scale withdrawals, rising physical demand, and falling prices, you start to see a very different picture than what mainstream narratives suggest. This is not weakness. This is accumulation. And if you understand this phase correctly, you are already ahead of most market participants. Welcome to Gold Silver Scope, where we break down complex movements in gold and silver markets into simple, clear insights so you can understand what's really happening behind the scenes. Because right now, the real story is just getting started. Now let's go deeper into what is really happening inside the system, because this is where things start to become even more serious. In the gold and silver markets, there are two worlds that exist at the same time. One is the paper market, where contracts are traded in huge volumes every day. The second is the physical market, where actual metal is stored, delivered, and moved. Most of the time, these two systems run smoothly together, but right now, there are signs that they are starting to disconnect. Let's understand this in a simple way. Every month, there are thousands of contracts traded that represent gold and silver. Each contract is supposed to be backed by a certain amount of real metal that can be delivered if someone asks for it. But in reality, the number of contracts is far higher than the amount of metal that is actually available for delivery. This is called open interest, basically the total number of active contracts in the market. Now here's the problem. When you compare the number of these contracts with the amount of physical metal that is actually ready for delivery, the gap is massive. Under normal conditions, this is not an issue because almost no one asks for delivery. Traders simply close their positions before it reaches that stage. But that behavior is now changing. More and more participants are choosing to stand for delivery, meaning they are saying, "I don't want cash, I want the actual metal." And when this starts happening at a larger scale, it creates pressure on the system. Because if too many people ask for physical metal at the same time, there simply may not be enough to go around. This is what some experts describe as a potential run on the vault. Think of it like a bank. As long as most people keep their money in the bank and don't withdraw it all at once, everything works fine. But if everyone suddenly shows up and demands their cash, the system breaks. Because banks don't keep all deposits in physical form. The same idea applies here. Now let's look at some real numbers to understand the scale. In a recent delivery cycle, over 1 million ounces of gold and nearly 6 million ounces of silver were marked for delivery in just one period. And if we look at previous months, the numbers are even larger, tens of millions of ounces of silver moving through the system. These are not small figures. We are talking about billions of dollars worth of metal moving every single month. And it doesn't stop there. There are also large withdrawals happening from storage categories that are not even meant for sale. For example, millions of ounces have been removed from what is known as the eligible category, metal that is stored but not actively listed for delivery. When that kind of metal starts leaving the system, it means someone is taking direct ownership and moving it elsewhere. To give you a sense of scale, just 2 million ounces of silver weighs roughly 168,000 pounds. That's not something you move quietly or casually. And in some months, we have seen close to 40 million ounces leaving. That's over 2 million pounds of silver being transported. So this is not theory. This is real, physical movement happening on a massive level. Now combine this with what we discussed in Part 1, record imports by China, aggressive accumulation, and price weakness. All of this points to one key idea. Physical metal is becoming more important than paper claims. And this shift is critical, because the entire pricing system is based mostly on paper trading. Prices are discovered in these large exchanges, where contracts are bought and sold rapidly. But if physical demand keeps rising, while supply inside the system keeps shrinking, eventually something has to give. Either the price must adjust higher to reflect true demand, or the system faces stress due to lack of available metal. This is why many analysts are starting to pay close attention to delivery trends. Another important detail is that historically, about 99% of contracts never went to delivery. That was the norm for decades. But now, we are entering a phase where that assumption may no longer hold true. And this is what makes the current situation different from anything we've seen before. It's not just about price anymore. It's about who actually holds the metal. Because at the end of the day, paper contracts can be created easily, but physical gold and silver cannot be printed. They have to be mined, refined, and transported. And that takes time. So when large players begin to demand physical delivery instead of paper settlement, they are effectively testing the strength of the entire system. Now let's connect the dots globally. Because what's happening is not limited to just one exchange or one country. This is a global shift in how gold and silver are being accumulated and moved. One of the most important questions you should be asking is this: who is actually buying all this silver? Because when you're talking about tens of millions of ounces moving every month, this is not retail investors. And it's not small institutions. This kind of scale points toward very large entities, and most likely, sovereign-level players. In simple terms, governments or government-linked institutions. Let's break this down logically. We know that China is already one of the largest producers of silver in the world. But despite producing so much domestically, it is still importing record amounts of silver, even after aggressively sourcing metal from countries like Mexico and Peru, which are among the top global producers. Now think about that. If a country is already producing large amounts of silver and still going out into the global market to buy even more at record levels, that tells you something very important. It tells you that they are not buying for short-term use. They are accumulating. And when accumulation happens at this level, it is usually strategic. This brings us to a concept known as Occam's razor. The simplest explanation is often the correct one. If massive quantities of silver are being bought, transported, and stored, then the most logical conclusion is that it is going into large-scale vaults controlled by powerful entities. These are not small warehouses. These are high-security storage systems capable of holding thousands of tons of metal. Now let's look at another critical angle. Could some of this metal be leaving Western systems and being shipped directly to other countries like China? The short answer is yes, it absolutely can. The system allows it. Markets like COMEX can deliver metal to participants who then have the option to transport it wherever they want. There are even structured mechanisms that allow contracts bought in Western markets to be converted into physical metal in locations like Hong Kong, and from there, it can be moved into mainland China. So what you're seeing is not just buying, it's a flow of physical wealth across regions, from west to east. Now, are there safeguards to stop this? In theory, yes. Certain metals are considered strategic resources, and governments can place restrictions on exports if needed. But in practice, these controls are not always enforced strictly, especially when transactions are happening through complex global channels. So large amounts of metal can still move quietly. And this creates an important question. Is the West losing control over its physical metal reserves? We don't have a clear answer, but the trends suggest that a significant portion of metal is leaving major exchanges and not returning. And here's why that matters, because the entire system relies on confidence. As long as participants believe that they can get physical metal when they want it, the system remains stable. But if confidence starts to weaken, if people begin to question whether the metal is really there, then behavior changes quickly. More people start demanding delivery, more metal leaves the system, and pressure builds. Now let's add another layer to this. There are increasing signs of unusual activity within the system itself. There have been multiple technical glitches and disruptions in trading over recent months. On the surface, these may seem like normal issues, but when they happen repeatedly, both on upward price moves and downward moves, it raises questions. Because markets of this size and importance are designed to be stable. So when irregularities start to appear alongside rising delivery demand and shrinking inventories, it creates a pattern. And patterns are important. Individually, each event may not seem significant. But when you put them together, record imports, massive withdrawals, rising deliveries, global movement of metal, and system irregularities, they begin to form a bigger picture. A picture that suggests stress building beneath the surface. Now it's important to stay balanced here. This does not mean the system will collapse tomorrow. Large financial systems are resilient, and they are supported by powerful institutions that have a strong incentive to keep things stable. But at the same time, no system is immune to pressure, especially when its weak points start to be tested. And in this case, the weak point is clear: the gap between paper claims and physical reality. That gap has existed for a long time. But now, for the first time in decades, it is being challenged at scale. And when that happens, the outcome is not always immediate, but it is often inevitable. This is why smart money focuses less on short-term price movements and more on long-term positioning. Because while the surface may look calm or even bearish, the underlying currents are moving in a very different direction. And those who understand this shift early are the ones who benefit the most. Now let's focus on what may be the most critical part of this entire situation, the structural weakness inside the system that very few people truly understand. For decades, the gold and silver markets have operated on a simple assumption. Most participants will never ask for physical delivery. This assumption allowed the system to grow very large. Massive volumes of paper contracts could be created and traded freely, because in reality, almost all of them would be settled in cash before delivery ever became necessary. This is how price discovery has worked for years. Producers, miners, and large companies use these contracts to hedge risk. Traders use them for speculation. And because physical delivery was rare, the system never faced real stress. But now, that assumption is being challenged. And this is where the real risk begins. You see, the ability to take delivery of physical metal was always there, but it was like a hidden feature, rarely used. Now, that feature is being actively exploited by large players who understand exactly how the system works. They are doing two very important things at the same time. First, they are selling paper contracts in Western markets, which helps control or suppress the price. Second, they are buying physical metal elsewhere, quietly and consistently. This creates a powerful strategy, because when prices are pushed down through paper selling, it creates the illusion of weakness. That discourages average investors, but at the same time, it allows large players to accumulate physical metal at lower prices without attracting too much attention. This is what we call price misdirection. The price you see on the screen does not always reflect the true demand for the asset. Instead, it reflects activity in the paper market, which can be influenced. And this is exactly what seems to be happening right now. While prices move sideways or even downward, physical demand continues to grow. Metal is being removed from exchanges, transported across regions, and stored in large quantities. Now, let's talk about another important point: why this has never been a problem before. As we discussed earlier, historically, around 99% of contracts were never delivered. That kept everything stable. No one had an incentive to challenge the system because it worked for everyone. But today, incentives have changed. Why? Because global dynamics have changed. There is increasing competition between major economies. There is growing interest in hard assets. And there is a rising awareness that physical ownership matters more than paper claims. So now, instead of just trading contracts, some participants are choosing to convert those contracts into real metal. And this is where the system starts to feel pressure, because the system was not designed for large-scale delivery. It was designed for liquidity, speed, and efficiency, not for mass withdrawal of physical assets. Now imagine what happens if this trend continues. More participants start asking for delivery. More metal leaves the system. Available supply becomes tighter. At some point, the system has to respond. It can respond in a few ways. It can try to reduce open interest, meaning fewer contracts in the system. It can increase margin requirements to slow down participation. Or it can allow prices to rise significantly to balance demand and supply. But none of these are simple solutions. And this is why we are starting to see signs of stress. For example, there have been multiple unusual events in recent months: sudden trading halts, unexpected system glitches, and irregular market behavior. These may seem minor on their own, but when they happen repeatedly, they raise concerns, because markets of this size are not supposed to behave unpredictably. Now again, it's important to stay grounded. This does not mean everything is about to break overnight. Large institutions, the biggest players in the system, have a strong interest in maintaining stability. They will do everything they can to prevent a crisis. But even the strongest systems have limits. And when pressure builds slowly over time, those limits eventually get tested. What makes the current situation unique is that we are seeing multiple pressure points at once: rising physical demand, shrinking available supply, increased delivery requests, global movement of metal, and signs of stress within the system. Individually, each of these can be managed, but together, they create a situation that is very different from anything we've seen in the past. And this is why many experienced analysts are no longer focusing only on price. They are watching flows. They are watching deliveries. They are watching inventory levels. Because those are the real indicators of what's happening beneath the surface. And right now, those indicators are pointing in one direction: a slow but steady tightening of the physical silver market. This tightening may not show up immediately in price, but over time, it becomes impossible to ignore. And when that moment comes, the adjustment is usually not small. It tends to be fast and significant, which is why understanding this phase before the broader market catches on is so important. Now, let's bring everything together, because when you step back and look at the full picture, the message becomes very clear. We are not just looking at random market movements. We are looking at a pattern where silver prices are pushed down, while at the same time, massive amounts of physical metal are being quietly accumulated. A pattern where millions of ounces are leaving major exchanges every month. A pattern where global players, possibly even at the sovereign level, are securing real, tangible assets instead of relying on paper promises. And most importantly, a pattern where behavior is changing. For decades, the system worked because no one really challenged it. Contracts were traded, risks were managed, and physical delivery remained a small part of the market. But now, that behavior is shifting. More participants are asking for real metal. More metal is being removed from circulation, and more attention is slowly turning toward the physical side of the market. This is how major transitions begin. Not with a sudden explosion, but with a quiet shift that most people ignore at first. Now here's the key insight you need to understand. Price is not always truth. In fact, in markets like gold and silver, price can sometimes act as a distraction. It can create fear when opportunities are building, and confidence when risks are increasing. Right now, the price action in silver has made many investors lose interest. It has created doubt. It has made the asset look weak. But when you look beyond the price, when you focus on physical flows, global demand, and long-term accumulation, you start to see a completely different reality. A reality where silver is being treated as a strategic asset. A reality where supply is slowly tightening. And a reality where those who understand the difference between paper and physical are positioning themselves ahead of time. Now, does this mean the market will move tomorrow? Not necessarily. Timing is always uncertain. Markets can stay disconnected longer than most people expect. Price can remain suppressed even while demand increases. And large systems can continue operating even under pressure. But here's what history teaches us. When fundamentals and reality move in one direction for long enough, eventually price follows. And when it does, the move is usually not slow. It tends to surprise the majority. That's why the real advantage is not in reacting late. It's in understanding early. Understanding what smart money is doing. Understanding where physical assets are moving. And understanding how the system actually works behind the scenes. Because once you see that clearly, short-term noise becomes less important. You stop chasing headlines, and you start focusing on long-term positioning. This is exactly the kind of perspective we aim to bring you on Gold Silver Scope, breaking down complex market movements into simple, clear insights so you can stay ahead of the curve. If you found this analysis valuable, Make sure to stay connected with Gold Silver Scope for more deep insights into gold and silver markets.